appropriate. Probably I'll wait till the end, but if there's some burning question, we will butt in and go with it. In the meantime, I'll introduce you to Navin to get us kicked off.
Thank you, Colin. Good morning, everyone. Just to introduce the team that I'm with. So Richard Lum and Eduardo Montero, the co-CIOs and PMs of the fund, and Mike Egan, the CFO, all of whom I'm sure you guys have met or heard from in the past. So there was a lot in the announcements this morning, and we will break the presentation into three components: capital allocation, the financial highlights, and the portfolio update. And just a few key points, and just to summarize from my side, I'm hoping you'd be delighted with the Q4 NAV print of just over 10% for the last quarter. And this translates to an annualized 10% since IPO in February 21. So the NAV is something that we can control with active asset management and what we acquire through the experience of the team. But what's more exciting is that there's still more underlying growth in the strategy, in the assets themselves. And these numbers, including the dividend, all with low leverage. We have minimum leverage in the portfolio, around 2% at the fund level. We also announced a dividend increase for Q4 of 2.9% from a portfolio that is 58% operational. This exceeded the 2023 target, and we've also increased the 2024 target by the same amount of 2.9%, showing again strong cash generation in the underlying portfolio. And of course, we announced an extension to the buyback program that we announced previously in September. So that takes a total to now £20 million. And we also want to take the time over the course of the next few slides just to remind you of the valuation process. So of course, there was a move in the discount rates as well as active management on the assets. But just to remind you of the transparency and how we model the discount rate, as well as the unique operating partner model. So whilst we may have the team here in London, we have over 100 people on the ground across our assets around the world. So just lastly, just to finish off on my side, again, very confident on the underlying growth in the portfolio as we transition to a more operational portfolio this year. Opportunity set remains vast and large, and we're excited about that as well. And what we want to do is continue our core activity, which is investing in sustainable energy infrastructure assets and accelerating the energy transition. And with that, I will pass it on to Richard.
Thanks, Navin. Good morning, everybody. Thanks a lot for joining us. Obviously, we're all very excited about the Q4 NAV print, and you can probably tell that on our faces. Before we go into the guts of the presentation, I'd like to just reprise some really important messaging about the uniqueness of GSEO as a strategy. And this slide does that. Obviously, this is a very diverse opportunity set that we offer investors. The opportunity set itself, in terms of investing in sustainable energy globally, is very strong, remains strong, and Eduardo and I are very convinced this provides us with a platform to build the fund moving forward. It is diverse from a technology perspective, and also it's globally diverse, offering investors also an inbuilt hedge, as it were, in the portfolio on the downside. It offers shareholders also very high visibility of cash flows. This is an infrastructure cash flow play here. We offer cash flows over a long term to investors, and that visibility of that's inflation linked on the revenue contracts. Over 90% of our revenues are contracted. Sector leading target returns here. The total target NAV return of 10% net of costs and expenses and leverage since IPO in 2021, we believe is sector leading. There's very little debt in the portfolio as well. It's under 11, and therefore minimal interest rate exposure, and certainly no exposure to subsidies. This is a post-subsidy strategy itself. And of course, the fund is SFDR Article 9 compliant, and the way that we originate new opportunities is compliant with UN SDG principles. Now, another message that I'd also like to convey right at the outset is, obviously shareholder returns and optimizing and enhancing shareholder returns very much at the heart of what we do, and that is enshrined in our capital allocation discipline that we have. Moving out on the left-hand side here, we're very pleased to note that we're able to continue with the accretive nature of our dividend policy in 2024 versus 23. It's increased by 2.9%. Very happy about that. In the current environment, we're obviously very cognizant of offering investors as well some confidence and some comfort there. And you would have heard this morning we've extended the £10 million share buyback program by a further 10 million, bringing it in total to 20 million. The capital recycling elements of Eduardo and I, our activities in portfolio management is very active. We constantly look at the portfolio to see how we can high grade it further through either a combination of realizing value through asset sales, if it makes particular sense, or indeed striking strategic partnerships with third parties, whether that's capital or industrials, or indeed pivoting from one asset class to a more high yielding asset class, project that is more accretive, or indeed deploying further capital into existing operating assets to further hybridize them or expand them. Now, Navin mentioned earlier, we have a unique operating model, and the uniqueness here is that we seek to address the global energy transition across several energy markets. And the manner in which we do this is to strike up joint venture models with operating partners. These operating partners have unique insight into local energy markets throughout the world. And in harnessing this joint venture model, we're able to actually accrue over 100 people that is dedicated to maintaining and optimizing GSEO assets all over the world through our 5 established operating partners. And through them, we're actually addressing 4 energy markets throughout the world, including Brazil currently, Australia, the UK, and North America, well, certainly the US. And we may well add to this as we increase our activities moving forward. Now, one very good example of our optimization activities is on the first asset that we acquired post-IPO, which is the US terminal storage assets. Here, what we've done is we didn't only acquire the assets for their infrastructure-like cash flows, but we actually renegotiated the contracts when we first came in with one of the largest clients there, the National Energy Company of Mexico, on better terms, better pricing terms, more volume throughput. We increased the utilization of the facilities, and that allowed us to access greater ancillary revenues, services revenues from our clients as well. We also invested further capital to expand the asset. We expanded it by a further 300,000 barrels, and that created additional revenue opportunities as well. What all of that meant was we doubled the EBITDA that we had when we first acquired the asset of about $6 million a year, more than doubled it to $15 million a year. And I want you guys to just let that sink in as it relates to what we're experiencing externally in terms of the discount in the market. We doubled the value in this for shareholders. That's what we're about as active portfolio managers, increase the EBITDA margin from 49% to 57%.
And with that, we'll go to Mike for the financial highlights.
Good morning, ladies and gentlemen. As mentioned, it's been a very positive quarter with NAV increasing more than 10%. We unpack those moves in this NAV bridge. We paid dividends in the quarter. We paid 1.38p in the quarter, and as highlighted, we've increased our dividend by 2.9% to 1.42p this current quarter. We're targeting 5.64p for the 24 fiscal year. We've executed on the share buyback, which we announced in September, and we continue to support the share price with the further buyback we've announced today. Fund expenses have come better than forecast, resulting in an ongoing charge ratio for the year of 1.3%. We received distributions from investments in the period. This is a reminder to everyone, this is distributions on 58% of the portfolio that's operational. So we would expect greater distributions as we go through 24 and into 2025. The big move in this period has been the NAV, and they're primarily split between 2 categories. One is the improving macroeconomic environment, specifically related to risk-free rates and coming in of the Brazil country risk premium. That accounted for roughly half of the uplift in NAV. The other half is linked to active asset management. In particular, the Brazilian tax incentive. We renewed a Brazilian tax incentive on the Macarena asset. We've renewed this incentive for a further 8 years, and Eduardo will touch on that more in the slides to come. FX movements in the period have been negligible, and the FX movements between sterling, Aussie dollar, Brazilian real, and US dollars have largely offset each other. The net result is a closing NAV of 483 million pounds, or 116.46p per share. There's been a lot of discussion around discount rates and, what does that look like? So what we've done on a quarter by quarter basis, broken out the discount rates for each of the assets. And what we're seeing as the macroeconomic environment improves, these discount rates having a downward trajectory at this point in time. However, I'm handing it over to Eduardo, who's going to take us through our valuation methodology in more detail.
Good morning, everyone. So on the valuation methodology, I'd just like to emphasize that we do get a lot of attention on the discount rates, a lot of questions on that. But it's also important to emphasize how we approach our discounted cash flow models, what kind of cash flows we use in our forecasts. And also the end result of all that, right? The combination of the cash flows and the discount rates, we're also checking that with market references. So to start with, on the cash flows, we're not taking, these are reminder, the US asset example is a very good example of the optionality of these assets. You can extract more value. We don't incorporate that in the value in the cash flows. We are only incorporating the long-term contracted revenues that already have been secured. For example, on the hydro asset in Brazil, we just secured the tax benefit for another 8 years. That only reflected when it actually happens. We have also to look at the consistency of the cash flows versus how we construct the discount rates. What does that mean? So the leverage, there's no leverage in the system. That's what the discount rates are assuming. The long-term inflation assumptions that we put on the models on the cash flows, they are consistent with what we are using as a reference for the long-term inflation differential and also the risk-free approach. Now, on the other side, if you look at another example of optionality of these assets is the life of the assets, that it could be extended. We could repower a solar plant and have more than 25 years asset life. We don't reflect that in these cash flows. Again, we're assuming conservative asset life assumptions based on the technical feedback we get from our advisors. So 25 years, what do you expect from a solar plant? 30 years for a terminal, 25 years for the hydro. That's more to do with the concession period. So no optionality embedded in these cash flows. Now moving on to the discount rates, just to emphasize that some of you have gone through our methodology in detail. It's transparent. It's the capital asset pricing model. All the risk premium inputs that we use to build these discount rates are publicly available. You can build this discount rates yourself. The other point is they're up to date. So yes, there is some volatility in our NAV reporting because of the current environment. It's what's happening. There's a lot of volatility on risk-free rates. If what we're trying to capture here is that if this macro environment persists in the long run, this is what's going to be the value of these assets. Needless to say, there is more upside potential here because of where the macro is. Is it sustainable to have this high level of high interest rates? A question mark. The other point is this methodology of the discount rates and cash flows have been externally verified. So the board of the fund has commissioned a report from one of the big four, and the discount rates we got from them are consistent with what we get here. All in all, putting all that together, we have verified these valuations with reference points in the market. Again, so we're looking at precedent transactions occurring recently, and also looking at comparable trading examples, companies that have similar businesses to our assets.
Got a question here that might be appropriate now, Eduardo,
Sure.
which is referring to the method by which you come to the discount rates. And probably 31st December was a low point in the US yield in the short term. There's been a bit of bounce back since. Do you see that reflected within market activity, or is that just as in your physical assets And do you have a comment on how that impacts on your NAV?
Yeah, so we have a sensitivity, Mike, you can comment on that, you've done the numbers. But just to iterate, the cash flows are normal, and the cash flows are the cash flows. What's changing here is the macro, and we try to, reflect, is this gonna stay long term? The assumption is what's currently in the market is what is gonna be in the long term. And like in terms of sensitivity, what does that mean?
In terms of sensitivity, the easiest way to express this is what is a 1% move in discount rates? And a 1% move in discount rates equates to roughly 5.5 to 5.6p per share.
If we move on to the portfolio update, I'll pass it to Richard to just remind of the portfolio composition and the assets.
Thanks, Navin. So we're segueing now from the theoretical basis of discount rates, etc., to the reality of what we're providing shareholders here, which are long-term infrastructure cash flows. And there's three things that I want to actually express in terms of messaging here. The first one, on the left-hand side there, you'll see the map, the distribution of our assets throughout the world. It is a globally diversified strategy and also diversified by technology too. So we offer an inherent built-in hedge here in terms of the diversification, but also we're able to access opportunities in individual energy markets throughout the world because the transition is global. Now, secondly, on the right-hand side here, we see that in the portfolio, 58% of the portfolio is currently operational, but that underpins a 1.1 times dividend coverage. What does that mean? It means 42% of the portfolio will benefit from construction uplift as we move throughout the year. And that is what shareholders have got to look forward to in addition to the operational cash flows we have today. The quality of the portfolio is high, and Eduardo and I go to bed every night thinking about how we can create additional value from the assets that we currently own. Now, those are the two first messages. The last message I want to give you, if we can move on, please, to the next slide. And here is a presentation of the nature of our cash flows from the projects. The revenue sources are on the underlying portfolio, and you'll see here it is almost wholly over 90% contracted over the long term. Gives you high visibility of cash flows over the long term. The dark green area, that's the contracted bit. And you see the lighter green area there is the uncontracted bit there, which is related predominantly to our Australian investments. So investors have to look forward to the idea that they have high visibility of infrastructure cash flows over the long term in this strategy. Now, if we break down the nature of these revenue sources on the next slide, you'll see here we've broken down the 5 particular programs that we have, and you'll see 4 of the 5 are contracted over the long term. They're long-term asset lives. They're contracted over the long term with highly rated and substantial counterparties. In the US terminal storage assets there, you'll see 3 years rolling. It means it's automatically renewed. So therefore, it is a long-term contract. The only issue is we always want to improve the pricing as we roll these contracts over. Within the context of Australia, that's probably the only program where we have consciously decided to have market exposure. And the reason for that is Australia, we've identified as undertaking the transition in a very disorderly way, where the majority of supply power has been through coal-fired power plants. And now there is a large penetration of renewables, which is much cleaner, but also much more intermittent. That creates some type of volatility in the pricing of power during the day, which we would like to access. We want access to that type of margin. So what we've done there is we've coupled our solar power plants that we build or acquire together with battery storage in order for us to capture the very cheap or free solar during the day and dispatch that power at peak prices in the evenings and the mornings. And once we've built out that portfolio, then we're going to hedge that fully built out portfolio. 50% of it will be hedged and 50% open to market pricing.
Moving on zooming into the portfolio, so the Brazilian solar PV assets. To recap, there are 16 distributed generation solar plants that we're building. They are contracted directly with the end users. So 10 of them are already in operation and generating cash flows. 3 are being finalized in the coming weeks. They will be up and running. And following that, we will do the final 3 to get to the 16 and the full program in place. Just want to emphasize here, Brazil is a very hot market at the moment. there's a lot of new entrants coming in this particular segment, in solar PV. A lot of institutional, international players coming in, a lot of local players also having a lot of interest in this type of asset, especially operational ones. So that gives you a hint of what we could consider here. Moving on to the hydro asset. As a recap, this is a facility that we acquired from EDP back at the end of 2022. There's been a very good transition now from our operating partner. They are fully in control of this plant at the moment. It's a very good performer. In 2023, we got a EBITDA 14% above budget. Reemphasizing our active management approach, we have secured the extension of this tax incentive of this plant for another 8 years. This is a federal tax. This has nothing to do with subsidy. So GSEO is a post-subsidy strategy. This is about providing incentives for activity in poorer regions of the country. So we secured that for another 8 years, and that had a quite significant impact on our NAV, as you could see. And as Richard mentioned, these are all contracted long-term cash flows here.
Moving on to our US terminal storage assets, I touched on this earlier as an example. We acquired it, just the first asset we acquired post-acquisition, very much with the mind of actually acquiring and then expanding and optimizing the asset itself. It's our buy, expand, and optimize strategy. Since then, what we've done is we've increased the EBITDA, we've more than doubled it from $6 million a year to $15 million a year as a result of us recontracting, recommercializing, and expanding the asset. We added a further 300,000 barrels capacity. It's currently at about just over 800,000 barrels. We're looking at commercial opportunities to expand it even further in due course. This gives you an example of how it is we identify opportunities and when we want to create real value for shareholders. And this should be seen in conjunction with the external factors we're facing off to at the moment in terms of what's happening in the market with the discount. We are able to more than double value in our investments through our active management. That's a really important point I want to get across to you.
Is it worth highlighting leverage?
So leverage here is the only asset we're currently levered up to 7%, just over 7%. And of course, that gives us more capacity to increase the leverage as we go on, should it be beneficial to us from a capital optimization perspective. Okay, I want to spend a little bit more time on the UK asset. It's much more unique, but also we've had some challenges, as you know, over the last year. It's a UK flexible power plant using natural gas that gets combusted. The exhaust there, the CO2 exhaust is captured, and we scrub it into what we call purified food grade CO2 that we sell into the food and beverage industry. The picture on the left-hand side there is what we call the stack gas recovery system that we received from ASCO, the manufacturer that is now on site, that scrubs the CO2 into purified food grade CO2. Now, what have we experienced thus far? All of the large equipment, for this project is now on site, including the Rolls-Royce reciprocating engines, the Turboden Org turbines, and the CO2 capture and scrubbing equipment, etc. We experienced a challenge last year with the incumbent EPC contractor having financial difficulties. We terminated that contract and we pivoted to a new contract with a new EPC contractor. That contract we're about to sign into very shortly. However, we have carved out key elements of that contract, and the contractor has started work on these activities already. There's been no cessation of work on this project with the new contractor. They commence work almost immediately. That's a separate package. And really, as a result of us having to recontract things, pay again the premium that was involved in the contracting arrangements initially. The overall capex for this project has increased. We have visibility on that figure now of about 16 million sterling at the outset. That figure is likely to be the outline figure and can come back in again as we complement this or offset this with the likes of a performance bond guarantee from a AAA rated insurer that we took out right at the outset of contracting with the previous contractor. We can claim on that, and our claim has gone in already. That will be processed and paid out at the end of the construction of the project. We also have access to liquidity in the project from the retention payments we withheld from the previous contractor, and also from the point in time that first power is achieved on this project. We are still expecting first power to be achieved in Q1 at the moment, to the point in time the whole integrated project becomes commissioned, and commissioning for that will enter into during the summer. That time period will be producing power. Pre-completion revenues there can also offset that 16 million figure moving forward. Now, we still believe, in spite of all of this, that the base case IRR will remain thereabouts at 7%. The reason for that is the commercialization aspects of the power in particular has become clearer as this project has matured. We have revenue stacking now that is more definable, including the balancing mechanism that this asset can sell into, including a new scheme promoted by the National Grid called the National Grid High Voltage Secure Services that we get capacity payments from, that has now further defined our revenue stack. Moving on then to the Australian program, very happy to reflect on the fact that we're building this out again. The key attractiveness of this program for us is we believe Australia is undertaking the energy transition in a very disorderly way, replacing very dependable yet very emittive coal-fired power with renewable power that is very clean. However, it is highly intermittent. So you need to have some level of access to peak margins that you can capture in the mornings and in the evenings. And we're doing this through the combination of solar power generation that we actually build or acquire, together with putting on battery storage next to it as well. We're hybridizing these solar power plants. The first hybridized facility we had is in South Australia. We completed that hybridization late last year, and that we're pleased to also reflect on the fact in November last year, the average captured power price that was experienced by our battery on site was about 200 Aussie dollars per megawatt hour, which actually is 4 times higher than the average captured prices for solar during that same period. Now, post-period, the 3 further sites we acquired in New South Wales to build new solar power plants on have now been fully commissioned. They're producing power now, and we're in the process of hybridizing those as well. That will come online by the end of this year. It should be noted, we believe Australia is much more interesting for us as it relates to a storage play than the UK is, because we believe the margin that we can access will sustain over a longer period of time. The price signals are much more amenable for investors to come in and capture those types of margins. Just to summarize, a couple of themes just to summarize and leave you with as we conclude our presentation. GSEO offers investors sector-leading returns, that's undoubted. Since IPO, the annualized target total NAV has been about 10%. There's minimal leverage in the portfolio itself. It is an under-levered strategy here, which means we have been protected from the higher interest rates environment. And this high cash generative nature of the portfolio itself, about 90% of the portfolio is under long-term revenue contracts, and also the fact that only 58% of the portfolio is currently producing or operating and producing cash flows, which is underpinning a 1.1 times dividend coverage ratio. You're going to expect further construction uplift as these assets go on stream. And the active asset management that Eduardo and I think about a lot, we believe creates additional value in the portfolio too. Eduardo alluded to it earlier as well. We pick up on signals from the market, for example, such as in Brazil, where large institutional players are now coming in and becoming very interested in the distributed solar side of things. This is an investment that we accelerate. We acted as an accelerator at the beginning to come in, create interest. There is now significant interest there. We pick up on these signals as we decide about active portfolio management, whether we recycle capital, etc. There is an experienced management team that is underpinning this strategy. And of course, we continue to demonstrate strong investment stewardship. I'll just stop there.
Thanks very much, Richard.